Welcome to the Broken Pie Chart Podcast, episode 320. I'm your host, Derek Moore. Solo this week. Crazy week in markets. When I look at, we had the 8th, there it is, on April 9th, tied for the 8th largest daily percentage gain in the S&P 500, plus 9.52%. It's another reminder that typically when you have the largest down days, the largest up days, they're all sort of clustered around each other. You know, if you look back at, and I don't see, the largest percentage losses, we haven't broken into the top 20. I'm looking at this on Wikipedia, by the way. I forgot to do this research, and I'll assume this is correct for now, but I haven't verified this. Maybe it's 8, maybe it's 9, maybe it's 10, and this is since 1923. Now, some of you might say, well, the S&P wasn't created until the 50s. Technically, that's correct, but there was an S&P that was first introduced in 1923. But getting back to biggest days, largest down days, 2008, you'll see a bunch of the biggest up days. For example, in 2008, October 13th, plus 11.58%, October 28th, plus 10.79%. And then you go in 2008, October 15th, minus 9%. You look at, let me see what else we have on here. Well, here was one, March 16th of 2020, minus 11.98. And let me see what else we got in here. Was that 1920? Yeah, 2020. And 2020 has some of the 10th and 11th biggest up days ever, plus 9.38%, plus 9.29%. It's sort of another reminder of if people are out there and investors, and I know it's really hard to do this, to not try and time the market. But inevitably what winds up happening is people are invested in the market, and we know that when markets are at all-time high, people want to invest more. When markets are making lows, typically what happens is investors kind of think, well, wait a second, maybe I'll wait. Maybe I'll wait until things get better, or maybe I'll wait until things settle down. And the challenge with that, you just don't know where the bottom is. And I'm going to talk about, did we reach the bottom or not, in a second. And by the way, I don't know. But there's sort of some data to say that when we see this, maybe we do see a little upward momentum here. But coming back to the cluster of days, I mean, these are big moves. I think somebody on Twitter, let me find it for you. Who is this? Eddie Elfenbeing on Twitter said, today's percentage loss, and I believe this was referencing Thursday. Yeah, I think it was it Thursday? Or was it? No, Thursday was the big up day. Friday was down day. Okay, so he's saying, I'm not sure exactly what, but you'll get what I'm saying here. Today's percentage loss was worse than every single day in 2023 and 2024. Yet 2 of the last 6 days were worse than that. Meaning, whatever the loss was that he was referencing in the last week or so, it was worse than any day in 23 and 24. But there have already been 2 worse down days in 2025, to put that into perspective. And, the other thing I would say is when you look at think about this. The geometric average historical return, according to Professor Aswath Damodaran at NYU Stern, because I know where to find this and it's easier for me to pull up rather than me do it. So thank you, Professor. Is 1928 to 2024, 9.94% is the average geometric return. The average arithmetic return is 11.79. So then you kind of come in here and you say, Thursday the 9th, the market is down. I believe it's still down for the day. And all of a sudden, the information comes out that we are pausing, or the Trump administration, I'm certainly not making these decisions, has decided to pause for 90 days the tariffs on 75 countries because they are negotiating, keeping them on China. And the market, I'm looking at the time on this. And it looks like about, this is military time, so 13:14. So what's that? That's 1:14 in the afternoon. And this is Eastern time, so New York time. And then it makes the high by, what is that, 15:48. So what is that, 15:48? See, now I'm all messed up with my times. Hang on. All right, that's like 15 minutes to go on the market. So the market moved from that point to the high. It was plus 8.48%. What did I just tell you? The annualized compounded growth rate is 9.94 from 1928 to 2024. The market literally moved in a little over 2 hours, as much as it moves in some years. Think about that. So what we're seeing right now is extreme volatility, but we're also seeing some pretty big extremes in just if you think about the distance between the low of the day and the high of the day, these are very, very extreme moves. And one of the things that we've been kind of talking about internally is the VIX Index. And if I do a chart, I thought it was higher than this, but I'm looking on Bloomberg and I just said the highest price for the day on the VIX Index, which of course is a spot index. You can't trade it. And it looks like the VIX did not get above the August 5th high when it was, what did it reach then? Reached about 65.73. So this is saying it just touched 60 or a little bit over 60. And, here's the other thing. Like coming into, if I look at the 8th, let me see. So that's the 7th, the 9th, the 8th. So the 8th, think about that. 57.52 was the VIX index. And the VIX index, 57.52. So if we take 57.52 divided by 15.875, you all have heard me do this before, is basically you take the square root of time, 252 days, you take the VIX, it's a good enough proxy as any. Is it the right way to do this? Not really. I'd probably want to look at the implied volatility of the options market. And you divide that by 15.875 and you get 3.6%, which is basically the one standard deviation expected move by the options market. I just told you intraday in 2 hours went up like over, it's like, and I think the swing from the bottom to the top was something like 10% or even more than that. So volatility is not pricing in the actual moves. We call this the disconnect between implied volatility, what is the expected volatility in the markets, and what is the actual volatility? What's the actual changes that you see? And thinking about this, if the VIX was 110, it would be like, right around 6.9, just rounded up, 7% expected one standard deviation move, up or down. So I'm still saying that VIX is not high enough. It hasn't been high enough based upon the moves that we're seeing. That's not a normal volatility environment. The normal volatility environment is that the market prices volatility higher, it expects higher, and typically it comes in lower. The last time we saw that was really 2020. And 2020, in March of 2020, you had these days where, let's say volatility was pricing in 6% moves or 5% moves. Remember, we were seeing 10% moves some of the days in 2020. I just mentioned two of the biggest down days were in 2020. So why does this matter? Right now, what we're seeing is, and we see this in the options market, you're not being compensated for the risk that you're taking if you're selling options. And believe it or not, normally, it kind of flips. Normally you say, well, I'd rather sell volatility than buy volatility. Buying volatility would have worked out. In fact, you always hear me say, right before earnings that, let me look at the straddle. Let me look at the buy the call, buy the put at the money, right where the price is. And you say, well, it's already pricing in earnings. It's already expecting a certain change. And there were several days where buying that straddle was underpriced. I'm not saying I have no idea what's going to happen Monday, Tuesday, Wednesday, or going forward. Don't go out and buy straddles. What I'm saying is it wasn't accurately reflecting what wound up happening. And that is an interesting dynamic in the market. I don't know why volatility wasn't higher. And I know that, some people say, well, Thursday was a very, very strong up day. Shouldn't the VIX have been lower? Remember, the VIX, it's called the fear index, and often it's because of how prices on the puts work, and you see the VIX go up when there's fear in the market, and that's all true. But if you're telling me that the VIX shouldn't have been higher to account for a move that was as big as some years get, I know, and I know during the year, the market oscillates, just doesn't start and go up, that much. It's not pricing in enough volatility. So there's something, and I'll dare say it, there's something a little bit broken in the options market right now, and with the way volatility is pricing. I'll give you kind of another point on how volatile the market has been recently. I'm sure many of you would say, hey, could you stomach the volatility of Bitcoin? I'm sure most of you would agree that Bitcoin is a pretty volatile asset. I think it was either Eric Baltunas or Joe Weisenthal from Bloomberg who tweeted out a chart showing the 10-day historical volatility. That's the actual volatility, what actually happened. And it was the SPY, US equity, historical vol over 10 days, and Bitcoin index, historical vol over 10 days. And SPY is at 74.88. Bitcoin index, 71.28. Like they're basically the same. So the S&P over a 10-day implied, not implied, let me correct that, historical, what actually happened, SPY has been as volatile as Bitcoin. I mean, does that make any sense? So, this obviously this reminds me of March of 2020. And the reason why it reminds me so much of March 2020 is simply because there was so much uncertainty. I think the FT, Financial Times, they have U.S. Policy Uncertainty Index, U.S. Economic Policy Uncertainty Index. Who is this by? Let me see. This is source Baker, Bloom, and Davis. Don't know who these people are, but the FT thought it was good to put it in there. And they are saying right now, and this is based upon this survey. Is it a survey or is it an index? I have no idea. It's a graph in a paper. In 2020, if you could see the chart, it's like 200, 400, 600. I have no idea what this even means. But I'm looking at the chart. You can see the line. Global pandemic, it's under 600. I don't even know what the number is. It's like up and to the right. It's almost like, it's not quite double what it was. And I don't have the context on this, but it's a pretty cool chart. And the reason, but getting back to the uncertainty, when you have uncertainty in the markets, what happens is, and I think I mentioned this last week, the analysts aren't really sure about earnings. Remember, in the long run, earnings are what matter. And I can tell you that according to Bloomberg, the consensus forward 12-month growth of earnings is 268.04 a share. That would still be a 9.15% growth rate. Remember last week I talked about how it was almost 272, almost 271. Now I have heard some people drop their forecast. We talked about Barclays last week. I've seen some other ones. And although I think Goldman Sachs actually was predicting a recession, and then when Trump paused the tariffs, they said they no longer predict a recession. That was quick. But what's happened is as earnings have come down and the market's gone up a little bit, the forward PE is actually back over 20 by a tiny bit. So if you take 20.01 times 268.04, the per share comes out to 53.6348, what the market closed at. So that's kind of a little bit of the wild card. Is we're into earnings season. We had Taiwan Semiconductor, and by the way, they had a really good report. If I'm looking here, let me see, year-over-year increase in net revenue, 41.6%. Year-over-year increase, 46.5%. All right, there's a lot of increases. I lost some of the legend on this. Yep, but they had, and month over month increase, there's 10%. So whatever they're doing, they're increasing their stuff quite a bit. And tariffs are, okay, here it is. March revenue plus 46.5% year over year, month over month growth plus 10%. Q1 2025 revenue plus 41.6 compared to the Q1 of 24. There you go, year over year. So a really good report. And we're going to be in earnings season. Monday we've got Schwab is coming out. Then Tuesday you've got another bank, Bank of America. United's coming out. ASML on Wednesday. Technology, something to do with chips there. TSMC was scheduled for 417, but they came out with earnings last week. Or if they didn't, that was a mistake by everybody posting them. But Netflix on Thursday as well. So we're getting into earnings season. And, if you look right now, so what are we coming into? Week of April 14th, 7% of the market cap is going to report this week coming up. The following week, 24% of the total market cap of the S&P is going to report. And then the really big week is the week of April 28th. That's 39% of the market cap. So we're coming into the thick of earnings season. But getting back to the forecast, uncertainty in 2020, economy gets shut down. It's uncertain what the earnings going to be. And I've seen some estimates floated out there. I just mentioned the 268. I've heard some estimates, it should go down to 250. It should go down to, maybe we'll have no growth. I think the actual for the prior 12 months was something like 245.57, according to Bloomberg. It's just a little unknown. But getting back to the kind of the typical thing that I, especially novice investors do, is they say, hey, I think earnings estimate's going to come down. So I think the market's going to come down. But typically what happens is the market, if you look at when the economy bottoms and when the market bottoms, the market tends to forecast things. The market tends to know. That's a good way of saying it. And markets come down a lot of times or go up ahead of events. We saw that where earnings estimates were still coming down in 2022 and the market had already bottomed and is starting to go up. So, there's uncertainty is the market doesn't like that. And then it comes to, okay, is it possible that we've bottomed in the market? Was this week, the pausing of the tariff. So the Friday was down day. Friday was down. It wasn't you have a day like plus eighth biggest day ever. You'd expect a little bit of a pullback maybe the next day. But, you look at the chart and you look at the market coming down. And one of the things that we see is, so we run a quant strategy. And we look at different volatility measures. We look at things like SPY options, and we look at those. And we're seeing levels that we haven't seen since March of 2020. So kind of getting, sure, on the uncertainty, there's uncertainty then too. I don't think there's as much uncertainty now as there was then. Think about that. The whole worldwide economy was being shut down. But let's say the bull case is that something gets worked out on China. The leaders figure out a way to save face and find a way to come up with, even if it's what they didn't initially want, they can come to something that lets them claim victory. And it could be President Xi, could be President Trump, could be any of the other nations. But, it's just one of those things that maybe it was the bottom, maybe it wasn't. But when people are ready to throw in the towel and say, I'm going to wait, I'm going to hang around for a while, sometimes that's a good contrarian indicator. Look, I don't know what's going to happen going forward. And that's why one of the primary things, the core thing that we do is buying, but hedging. But often when markets are at their worst, look at all the stuff that's happened. So we have this. We have March of 2020. 2008, 2009, and any time that investor is in those environments, it always seems like it's different. It always seems like it's bad. It's only going to get worse. And then when you look back, you say, oh yeah, maybe that was a buying opportunity. Again, I don't know what's going to happen this time. But that's why being in the market, being hedged makes sense to me. The other thing that happened this week, which was, well, let's talk about bonds a little bit. So high yield spread, that's something I watch. And if I go to, let me see, where's my high yield spread here? Where is my high yield spread? Well, high yield spread widened. And when high yield spreads widen, it means that the yield to maturity on high yield bonds, that minus treasuries, that widens out. In fact, if I look at my chart here, if I can find it, I think the high yield spread almost got to, let me see. Yeah, it almost got to 450 basis points. It came back in and is now 409 basis points. And for those of you playing at home, it's kind of if it's 450, it means, let's say high yield is 8.5%. What that means is treasuries are 4%, or something like that. It's a spread between the two. And that's notable, although I will tell you that treasuries, the yields actually increased. And that was a big deal. Treasuries, if I look at the 10-year treasury, it went from 4% almost to 4.5%. That's a 12.4% increase, or just under 50 basis points. That's a big deal. And the reason why that's a big deal is because when bond yields go up, bonds go down. And if you think about it, a lot of people like to hold bonds as a diversifying agent, but also as a protective agent, because the idea is that there'll be a flight to quality, or the Fed will come in and lower rates if there's trouble in the stock market, and bonds go up when equities go down. And I got to tell you, the correlation between stocks and bonds has been much greater, and especially in 2022, because it was the yields going up that were causing the problem. You remember that yields were very low, and 22 into 23, the Fed's raising rates, yields are going up, and yields didn't really explode on the back end of the curve, but they're still going up. Mortgage rates are tangentially aligned with the 10-year treasury yield. And so if you look at the 30-year mortgage rate and you look at the 10-year treasury, if the 10-year treasury yield is going up, in general, a good rule of thumb is the 30-year mortgage rate is going to go up. So Powell's hinted that I think he said he's more willing to consider lowering rates. And, inflation was rather muted, the one that came out on Wednesday, although with all the other news that came out, who can even remember that? A few days in the markets this week feels like a year. So the bond market move, though, wasn't great. And it wasn't great because that goes to mortgages. And when we first started to see the markets kind of, really sell off, you saw the 10-year starting to fall. I mean, the 10-year almost I think it broke intraday 4%. And so you're thinking, well, okay, maybe mortgage rates come down, borrowing costs come down, inherently maybe that helps equities. But when the bond market starts spiking like that, the yields start spiking, that's not necessarily healthy. And there's a lot of people speculating. I saw this, and who was saying this? It might have been somebody on Bloomberg. But their kind of summary was, look, they thought that Treasury Secretary Scott Bessent is the one who got Trump to pause for 90 days because he is a hedge fund manager. And if you don't know, he was an analyst for George Soros, who did the trade that broke the Bank of England. They had, you can Google it, you can see it there. But that's kind of I forget who it was on Bloomberg. It was on Bloomberg TV. But they were saying they think Bessent got to Trump and said, look, you can't have the bond market doing this. You cannot have bond yields spiking. At the same time, oil is making new lows, and looks like OPEC is increasing production. So it's kind of an interesting dynamic right now. But do watch the bond market, because bond yields spiking like that would not, to me, that would be a negative for the markets. You really don't want that. Will the Fed be able to lower rates? Well, if you take a look at the Fed funds futures, and remember what I always say, if you look at them now and you look at them in a week from now, they're going to tell you something different. And I think I had, 4 quarter point cuts were priced into the futures a week ago. It's now 3. So it's already come back down. So I caution anybody to watch the Fed funds futures, because they kind of, reflect the thinking at the time, but that's they change all the time as well. There is no, it's like a 24% probability they'll cut at the May 7th meeting, 0.879% probability, or 87.9% probability to cut at June, and then it's basically pricing in one cut for July. So, we'll see. They also could decide to end the runoff immediately. Their runoff on the balance sheet is pretty low right now, where they could actually go and start to buy bonds. They could go, the Fed could start buying 10-year treasuries to try and push the rate down and do a little curve control. So there's other levers they can push, but certainly but watch the yields there. The other thing I want to talk about is this a bear market or not? And technically it's not. I think we're at the very bottom. We're off the bottom now. Again, I don't know if that was the bottom or it's not. It was down about 18.9%. December of 18, it never got 20% or below. And is 20% sort of an arbitrary number? Of course it is, to call a bear market. If this was, if you think it's a bear market, I think it took about 47 days from the peak to the most recent trough. But there was some interesting data too. This is on Isabel Net via Ryan Dietrich, and it goes back to, it's a quote, since 1950, the S&P has surged 5% or more in a single day on 23 occasions. That's interesting. Since 1950, 23 is all the time it's surged. It's gone 5% or more higher. Only 23 times. That's a lot of days. So it doesn't happen often. It says a year later, stocks climbed an average of 26.9% with positive returns in over 91% of the cases. Good news for the bulls, end quote. So if I look at this graph, they have the percent gain going back to, this is since 1950. This only says, I think they're only showing 1970 on this graph. But if you look at it, most times the next day is negative. 5 days, let me see, the average is minus 1.7, or the median is 1.5, and percent positive 39.1. Okay. But there are some positive ones in here. 1 month, it's 69% of the time they're positive. 3 months, 56% of the time. 6 months, 69%, and then 12 months, 91.3%. So if you can kind of see this, and remember, the biggest up days cluster around the biggest down days. So more often than not, there's some issue. And honestly, a lot of these are like 2008, 2009, 2020. And then you have 01, 02, 08, or 87, 70. So, and you have 49 of 25. So does that mean we won't have more down days and up days? I'll let you know when I know. But this kind of is consistent with the fact that when you have these periods where there's a lot of upset in the market, and we're seeing in some of the volatility numbers, usually when volatility does this, and this, a lot of times the market is higher later. Look, I don't know what's going to happen, but I do know that you don't want to panic. You don't want to make an emotional decision. And if you have money in the market and you're thinking, oh, I got to get out, look, I don't know what's going to happen. And But more often than not, investors who aren't, who have a horizon out there of their investment life cycle, you don't want to make rash decisions, and you don't want to panic. And hopefully you don't do that. So, all right. Other than that, I'll just mention that it looks like the volumes this week were extremely high on a lot of things. Eric Baltunis had put a tweet out. SPY saw close to $500 billion in volume this week. Easily a record. I'm quoting him. Many studied ETFs had record weeks, including QQQ, HYG, VOO. So much trading and so much big fish trading. You're not getting these dollar numbers without institutional investors. And it's something like 473.905 billion. And if I'm looking at this, there's two other times going back to 2001 when the week's volume was over 400 billion. And it looks like sometime in 22, I think. Sometime it's probably March of 2020. And let me see when else, Yeah. So I don't know what that means, if anything. Probably doesn't mean anything, but there's an awful lot of trading going on this week. So, all right. Recommendations this week. I started watching Paradise. I don't want to give anything away, but it's really interesting, I think. I watched the first episode, and by the end of the first episode, there's sort of a twist that you find out. So I'm going to watch that. I'm going to check it out. And then, of course, the Masters this weekend. And as I'm recording this, I just finished watching it. And it's going to be Rory McIlroy against Bryson DeChambeau. There we go. DeChambeau tomorrow. Should be interesting. Rory can go for the Grand Slam, get the green jacket. Bryson has not won the green jacket before, but he did win the U.S. Open. And he's won some other stuff. So that's going to be really interesting. By the time you listen to this, that will probably be over. So I hope you enjoyed it. But I'm checking out Paradise. All right, everyone. We'll talk to you next week. Pay attention to the earnings this week. Watch the bond market. Watch volatility. See ya.